After the end of the gold standard and the rise of fiat currencies, the global economy entered a new era, one defined by debt, financial engineering, and easy money. Economies were no longer constrained by the amount of gold in vaults. Central banks could create money, adjust interest rates, and manage economic growth with tools and policies never seen before. At first, this flexibility seemed like a breakthrough. Governments could borrow more to fund infrastructure, social programs, and military spending. Businesses had easier access to credit for expansion and investment. Consumers could buy homes, cars, and appliances with loans that were suddenly more accessible than ever. But with fewer constraints came new risks and new temptations. Throughout the 1980s, 90s, and 2000s, the global financial system became increasingly complex. Financial markets didn't just fund businesses, they became businesses themselves. Investment banks, hedge funds, and trading desks developed sophisticated financial products. Derivatives, mortgage-backed securities, and credit default swaps, to name a few. Tools designed to share risk and also to magnify profits. At the same time, governments around the world accumulated record levels of sovereign debt, often to stimulate growth or respond to crises like the COVID pandemic. For a while, the system seemed stable, until cracks appeared. The 1997 Asian financial crisis, the 2000 dot-com bubble, and most famously the 2008 global financial crisis exposed the vulnerabilities of a highly leveraged, debt-driven economy. In response, central banks slashed interest rates and expanded money supply further, policies known as quantitative easing. These tools kept economies afloat, but they also fueled new debates. Were we solving problems or simply postponing them? Meanwhile, debt levels kept rising. Here in the 2020s, global debt, government, corporate, and household, have reached unprecedented heights. And with interest rates near historic lows for over a decade, the world has become accustomed to cheap money and easy credit. The age of debt brought on prosperity for some, but instability for others. It undoubtedly raised living standards in many places, but it also increased inequality and created fragile financial systems vulnerable to shocks. And as the global economy grows more dependent on debt and financial engineering, one question lingers. What happens when the next shock arrives, and there are no easy tools left to soften the blow? In the next episode, we'll explore how bailouts, bank runs, and digital currencies are reshaping the future of money, and whether that future is built to last. Hit subscribe and join us for the final episode, Bitcoin, Bailouts, and Bank Runs. Is money broken?